I'm Ryan and this is Market Lab. The Fed's been in the news a lot lately and it's rattling markets. In this video, we're going to explain the current situation and what the ramifications are for investors. Also, if some of these terms are foreign to you, check out this 3-minute primer on what the Fed is and what they do. Alright, let's get into it. So with the onset of the COVID pandemic, the Fed dusted off its old playbook from the great financial crisis, cutting interest rates, which, as you can see here, are back to levels they were at in the crisis, and going out to the market to purchase treasury bonds and other things like mortgage-backed securities, bank debt, and corporate bonds. Doing this helps keep longer-term interest rates low and pours new money into the economy. This is the off-sided quantitative easing. All this was done to help stimulate the economy and keep markets healthy to absorb the financial burden of the pandemic. So where are we now? To start things up, we should bring up the Fed's dual mandate, basically the two main jobs they're tasked with trying to positively impact. First, they strive for full employment, which, as you can see here, is pretty much back to pre-crisis levels. Next, they try to keep prices stable, which hasn't been going too well lately. In the summer and autumn, we were already starting to see inflation start to go through the roof. The talk, however, was that this was mostly attributable to supply chain issues and other unrelated things like Russia meshing with the oil and gas markets and weren't supposed to be long-term issues, or in Fed speak, that they were transitory. Increasingly, though, things have looked a lot less transitory, and economists in the Fed have progressively begun to acknowledge that, most notably after the Fed's December meeting when they really took steps to distance themselves from that word. So, coming back to the dual mandate thingy, employment and the economy appear to be on a good footing, but price levels are spinning out of control. So, it looks like it's time for the Fed to raise rates to combat inflation, and for J-Pow to step away from the quantitative easing printing press. We got the first concrete evidence of this at the Fed's November meeting. The Fed only updates the dot plot, the poll the meeting participants take for where they see rates heading in the future, which effectively acts as guidance on upcoming rate hikes every quarter. But it was clear that the 0 to 0.25 band was going to change very soon, and materially so. Additionally, they added a lot of commentary on trimming quantitative easing by mid-year. Investors took note, and it was one of the main focal points of the financial media, but the actual market reaction was pretty minor, and the hit to shares completely reversed itself in a few days. In part because the move seemed rather minor in the grand scheme of things, and also because a lot of people seemed to have lingering belief in the transitivity or transitoriness of inflation. That all changed after the Fed's meeting on Jan 6, when things became decidedly less chill. The Fed's tone was more hawkish, and the new dot plot and Fed statement implied more aggressive hikes sooner and a swifter end to quantitative easing. Most notably, overnight the expectations for a March rate hike increased dramatically. Leading into this, the street was growing increasingly expectant of sooner hikes, as seen here by the poll the banks provide of their expectations for rate hikes, but that seriously popped after the Fed meeting. Even post the Fed meeting, they are still in the news. On January 11th, at his confirmation hearing before the Senate, Powell found himself in the hot seat again. He painted a rosy view of the economy and struck a conciliatory tone regarding cuts in the face of a weakening economy, and the market rallied strongly afterwards. Only to wake up the next day to headlines saying that inflation in 2021 was the highest since 1982. Fun times. But why does this really matter? How much do modest increases to interest rates really impact the market? Well, and this is just my personal opinion, but probably not very much. Convention says higher rates hurt corporate borrowing, which leads to reduced expansionary spending. Individuals will borrow less, so fewer jet skis get sold, and savings accounts will pay an extra few nickels, so seemingly people will save more and spend less at in and out. But all of this is at the margin. Things need to return to a normal long-term level, and things getting there a bit quicker shouldn't have that much of an impact on stock valuations, which should be based on expected cash flows long into the future. However, the market tends to take a more short-term view and hyper-focus on headlines, and right now the top stories aren't particularly bullish for markets. Omicron is setting an ominous tone for the months ahead. Expectations for significant and broad-based wage growth across the US is building, most notably at the most recent non-farm payrolls report, where employment numbers look decent enough, but the strong wage growth numbers spooked investors and rates sold off. And amongst other things, let's not forget that markets are at an all-time high. So, with so many question marks out there, the Fed's actions are going to continue to have a microscope on them for the foreseeable future. Alright, so that's my quick summary of the current Fed situation. If you thought this video was helpful, please consider giving it a like. I'm Ryan, and thanks for tuning into Market Lab.